Hello and welcome. In this explainer, we're going to dive deep into Section 34 of the Income Tax Act 2025. Now, this is a big one. It's really the general rule for business deductions. So if you're a tax professional or a business owner, getting this right is absolutely essential. So let's just jump right in with a situation I'm sure many of you have wondered about. Your business pays for your home internet. Can you claim that entire bill as a business deduction? Well, the answer isn't a simple yes or no. It all comes down to the conditions in Section 34, which is exactly what we're going to unpack today. Here's a quick look at our game plan. We'll start with the basics, the legal foundation of it all. Then we'll decode the core conditions you need to meet. After that, we'll walk through a real-world example, talk about compliance and common mistakes, and wrap it all up with the key takeaways. Okay, first up, let's lay the groundwork for understanding Section 34. You can think of this section as the master key that unlocks most of your day-to-day business expense deductions. You see, while the Income Tax Act has very specific sections for things like depreciation, Section 34 acts as the general kind of catch-all provision. This makes it the go-to rule for the vast majority of your operating expenses. We're talking rent, salaries, marketing, you name it. Now, the actual language of the law is really important here. It says an expense must be laid out or expended wholly and exclusively for the purposes of the business. That phrase, wholly and exclusively, is the absolute heart of this section. It's the critical test. So let's break down what it really means in practice. So, that legal jargon really boils down to 4 distinct tests. Any expense you want to claim under Section 34 has to pass every single one of these 4 conditions, no exceptions. So here they are, the 4 tests. Think of it like a checklist. First, the expense can't be covered by some other specific section. This just prevents double dipping. Second, it has to be a revenue expense, not a capital one. Third, it absolutely cannot be a personal expense. And finally, there's our key phrase again, it must be wholly and exclusively for the business. Let's zoom in on a couple of those terms. Okay, this distinction between revenue and capital spending is fundamental in tax law. Revenue expenses are for the day-to-day running of the business. Think of it as the fuel. These are deductible under Section 34. Capital expenses, on the other hand, are for buying things that provide a long-term benefit, creating an asset. These are not deductible here. Instead, you'd typically claim depreciation on them under other sections. Similarly, the line between business and personal is a hard and fast rule. For an expense to be deductible, you have to prove it's directly tied to your business operations. Anything that's for your personal benefit, even if it comes out of the business bank account, is a no-go. It will be disallowed. And that brings us right back to our star phrase, wholly and exclusively. What does it really mean? It means the one and only reason, the sole motive for spending that money must be for your business. If there's a duality of purpose, meaning it serves both a business and a personal need, then it fails the exclusively test. It's likely to be disallowed, or at the very least, you'll have to split it. All right, enough theory. Let's see how these 4 tests actually work when the rubber meets the road. We'll use a practical example to make it all crystal clear. Okay, let's take a look at the expenses for a company, MSABC Traders. Office rent? That's a classic revenue expense for the business, so yes, deductible. Purchase of a new laptop? Nope, that's a capital expense, it's an asset. They'll claim depreciation, not a deduction under Section 34. The director's personal trip? Absolutely not. That's a clear personal expense. Staff salaries, a perfect example of an expense that is wholly and exclusively for the business, so yes. And finally, back to our starting question, the home internet bill. Is the full 2,000 rupee deductible? No, because it fails the exclusively test. However, the business portion, that 50%, can be claimed, but only if they have good records to prove that allocation. So now that you see how the rules work, let's talk about the practical side of things, how to stay compliant, and how to avoid some really common and often costly mistakes. I cannot stress this enough. Your documentation has to be meticulous. To back up any claim, you need the whole paper trail, invoices, bank statements, contracts. And for those mixed-use items, like a car or that home internet we talked about, a detailed logbook isn't just a good idea, it's essential to justify your claim. Now, beyond just keeping your own receipts in order, there's another major pitfall you need to be aware of, and that's non-compliance with tax deducted at source, or TDS, rules. Under Section 35B, if you mess this up, the consequences for your deductions are severe. The rule is painfully simple. If you're required to deduct TDS on a payment to a residence and you either forget to do it or you don't deposit it on time, 30% of that entire expense will be disallowed. Let's go back to our example company. say ABC Traders pays 5 lakh rupees in professional fees. It's a payment that requires TDS, but they forget. When it's time to calculate their taxable income, 1.5 lakh rupees, that's 30% of the 5 lakhs, is going to be disallowed. It gets added right back to their profit. That's a direct and very painful hit to their bottom line. So, to quickly recap, the big mistakes to avoid are mixing up your personal and business expenses, trying to pass off a capital expense as a revenue one, having sloppy documentation, not being able to prove why an expense was necessary for business, and of course, ignoring those critical TDS rules. Avoiding these is the key to solid tax compliance. All right, we have covered a lot of ground, so let's boil it all down to the most important points you need to remember to really master Section 34. Here are the 5 things to burn into your memory. 1. Section 34 is your go-to rule for general business expenses. 2. Every single claim has to pass all 4 tests. 3. Getting the difference between revenue versus capital and business versus personal right is absolutely critical. 4. Your documentation is your shield. It's non-negotiable. And 5. Always comply with TDS rules to avoid that painful 30% disallowance. And that's our detailed breakdown of Section 34. If you apply these principles, you'll be able to handle business deductions with a lot more confidence and accuracy. Thank you so much for watching. If this was helpful, please do like, subscribe, and share it with anyone else you think might benefit. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.